Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I'm actually very excited about the type of work that we're doing at Cambridge because we're getting a lot of client calls and reach out from people that want us to engage them and help them create a tax-free retirement life. Over the past few weeks, we've talked about some of the issues and concerns in dealing with retirement distribution planning and things that the vast majority of Americans out there in the marketplace, and I know the vast majority of my clients prior to engaging our firm, had not really paid any attention to. So we're excited. We're making a big difference in the marketplace. And at the end of the day, we feel very strongly that the more education that we can provide to each and every one of you, the better off we're all going to be. Now, today what I'm going to be discussing with you is our customized 10-step tax-preferred retirement blueprint. As many of you know, we've been doing these tax-preferred retirement blueprints for the last 12 years. And we, obviously, when we started, we were adding some things here and there, but over the last 5 years, we've done a tremendous job in making certain that there's nothing missed when it comes to scheduling and setting up a tax-free retirement life for our clients. The reason for that is very critical. We're at $21+ trillion in debt in this country. The unfunded liability, and that means money that we're supposed to pay because we have made a guarantee to pay and we just don't have the money to do so. So the unfunded liability for Medicare, Medicaid, Medicare Part D, and Social Security, the unfunded liability is north of $120 trillion today. And obviously we have had a reduction in taxes. What's really interesting about all of this is that we are at an all-time high debt in the United States, and we're pretty much at an all-time low in taxes, except for the very, very beginning of the tax code back in 1913. We have never enjoyed the type of tax level that we're enjoying today, especially after the Tax Cuts and Jobs Act of 2017. Now, the challenge with that is that all of that is going to go away in 8 years, unless a government decides to extend that. But based on all the information and the due diligence that we have done, there's a very, very high probability that taxes are going to be much, much higher in the future than they are today. So we pay particular attention every time that we engage a client, either in person or via video conference, in making certain that we can create a customized tax-preferred retirement blueprint. And there's a 10-step process that we use. I'm going to cover that process with you today. Bear in mind that some of this information that I'm going to cover fairly quickly is quite complex, but this is something that we do every day. Now, if you're a numbers person and you're very analytical, you may be able to do this for yourself, so we're here to help you. But at the end of the day, the vast majority of our listeners and people that attend our webinars engage Cambridge for this type of work because this is what we do every single day of the week. So the first step is to make certain that you have a strategic approach to what it is that you're trying to do. So it is very important that you become educated, that you attend a tax in retirement workshop, and we do those via online, or we do it at a local college or university here in South Florida. But most of the time, the vast majority of our clients want to do it online. Some of the clients have been asking, because usually we do it during the week, and some of our clients are asking if we can do it like on a Saturday morning early, so that way they don't have an issue with, traffic and driving and trying to make it home or staying late in their office in order to go through this type of webinar. Now, obviously, you also want to seek assistance from a qualified professional, but make certain that they do have a retirement and tax planning background if necessary. We at Cambridge, we're very, very good at doing three things. We specialize in tax planning. we specialize in insurance, and we specialize in alternative investments. I'm not going to go into all the details out of each section and what we do there, but that gives you a pretty good flavor as to what our capabilities are. Now, step number 2 is to do a complete audit of your existing assets. So you need to be able to identify all of your existing assets and or investment products that you may have, and you need to do so by amounts and also by investment sector type. Some investment sectors tend to appreciate quicker than others. Some are more volatile than others. So you have to make certain that you understand what it is that you have in those areas. Number 3, you have to figure out how much money you have in what we call as taxable buckets. And when it comes to a financial and a taxable standpoint, there are 3 basic tax buckets in the U.S. You have your taxable bucket, you have your tax-deferred bucket, and then you have your tax-free bucket. The taxable bucket, I think most of us understand, is primarily your money market accounts, your savings, your CDs, if you have traditional mutual funds. And the reason why they are called a taxable bucket is that at the end of the year, you get a love letter from the IRS in the form of a 1099, which means that every dollar that's growing inside of that bucket obviously is going to be taxable. Now, the argument is, well, how much money should you keep in your taxable bucket? The rule of thumb is approximately 6 months of living expenses. So if you make $100,000 a year, you should keep $50,000 and not more than that. Now, that taxable bucket can also be used for emergencies or opportunities along those lines. The next bucket is the tax-deferred bucket. In the tax-deferred bucket, that's a one that most Americans understand fairly well. That's where the money that goes in pre-tax, the money grows tax-deferred, but then when you pull the money out, it is totally taxable. And those are your IRAs, your 401ks. If you happen to be a public employee, would be your 403bs or your drop or defer compensation 457 whatsoever. So obviously in step number 3, you want to make certain that you do a future value calculation of all your current assets in those taxable buckets. And you want to make sure that you can run that calculation at anywhere between a 2 and a 4% hypothetical rate of return. Now, once you get into the tax-deferred bucket, because now you're looking at a bucket that is more long-term, you also have to conduct a future value calculation of those assets that happen to be in that particular bucket. And also, you want to make sure that you run them at a 4, 6, and 8% hypothetical rate of return. And what we're trying to do with each of these 3 buckets, we want to make certain how much money there's going to be available hypothetically at some point in time in the future. The last bucket that I'm going to discuss, which would be step number 5, because number 4 was the tax-deferred bucket calculation, is now you want to conduct a tax-free bucket calculation, which is primarily the same thing. You want to take a look at the future value calculation of all your current tax-free assets that you may have in this bucket. Interesting enough, those would be your Roth 401ks, your Roth IRAs, your municipal bonds, and your 7702 plans. And you want to use the same as you did in the tax-deferred bucket. You want to use a hypothetical rate of return of 4%, 6%, and 8% respectively. Now, what is challenging about the 3 bucket scenario that I have just explained to you is that the majority of the time, the vast majority of the money that my clients have when they first come in to see us here in our offices or via video conferencing at Cambridge, it's either in bucket number 1, which is the taxable bucket, or bucket number 2, which is your tax-deferred bucket. Very, very few dollars I find in the tax-free bucket unless they've done any type of proper planning from an accounting and a tax planning perspective. Now, step number 6 is you want to conduct a future value calculation of all the currently available Internal Revenue Service deductions, exemptions, and credits using a traditional 3% annual inflation rate. And what do I mean by that? Well, what I mean by that is the following. Right now in 2018, because of the new tax law, the standard deduction, unless you are filing taxes and you have more than the normal standard deduction, so you're going to be itemizing, but the standard deduction has gone up to $24,000 for married couples filing jointly, and $12,000 for individuals filing as single filers. So obviously you have to factor that in. So if you happen to be, let's say, 50 years old and you're going to retire at age 65, you want to take that number and you want to grow that number, that $24,000 or $12,000, depending on your marital status, for the next 15 years at a 3% increase inflation rate. Because what has happened over the last 30 years is that the standard deduction has been increasing steadily every year based on inflation or cost of living adjustment, as is described by the IRS every single year. Now, what's interesting about this right now is that all of those tax benefits, that $24,000 that I was just talking to you about, everything is going to be sunsetting in 8 years from now. So in year number 9, everything is going to go back to the old law that was in effect in 2017. By the way, for those of you that file your taxes on time this past April 17th, this is the last year, at least for the next 8 years, in which you're going to have to file taxes under the old law. Now, one of the main reasons why we want to do run those calculations is because at the end of the day, we want to make certain that our clients put as much money as they possibly can in the tax-free bucket, and by the same token that they can pull enough money out of the tax-deferred bucket that could be offset with the standard deduction, so there is no tax liability whatsoever. Now, one of the webinars that we do for clients on a weekly basis is called How to Divorce the IRS in Retirement, and how to do so legally. So this is one way that we at Cambridge specialize in making certain that by the time the vast majority of our clients retire, that the best tax bracket that they can enjoy in retirement would be a 0% tax bracket. So that is why we want to make certain in step number 6 that you have the ability to conduct that future value calculation to include your deductions and your exemptions and credits along those lines. Now, step number 7, now we're getting into the planning aspect of this customized retirement blueprint. And you want to conduct what we call a net present value, an NPV calculation using a 3% annual inflation rate of primarily step 3 and a step 4. Step 3 would be the taxable bucket, and step 4 would be the tax-deferred bucket. What is it that we're trying to do in this calculation? What we have to do is we want to figure out how much money do we need to have in the future in order to avoid any tax penalties or any tax liability under the IRS code. So we need to do a net present value calculation. So let's say that you're 50 years of age and you have $500,000 in your IRA combination with your 401k. Well, if we continue to grow that at a given, 4, 6, or 8% return, by the time you get to age 65, you may have close to $1.2 million, $1.3 million. Now, obviously, especially when you get to age 70, where you have required minimum distribution, which forces you, at least in the first year, to take at least 3.65% of the value of your 401k and IRAs. What if you have $1.5 million? Well, that distribution that now the IRS is forcing you to take out is much, much greater than all of the potential deductions that you could have under the IRS code. So therefore, now you're going to have a tax liability. And if we agree in the fact that taxes are going to be much, much greater in the future than they are today because someone is going to have to pay for the mess that we're living in, then obviously you have just given yourself an increase in tax rate without wanting to. And by the way, taxes are the biggest issue when it comes to retirement distribution planning. Only that and running out of money calculation, but we've talked about those along those lines. So when I conduct net present value calculations for my clients, I want to make certain that they don't keep any more money than they need to in the taxable bucket. In this situation with the client making $100,000 should be no more than $50,000, because anything else on top of that, will add some additional pain and suffering to your tax liability. But also, there is a right amount to have in your tax deferred bucket, because if you have too much, now you're going to be paying taxes in the future. And by the way, bear in mind that when you defer taxes today, you're also deferring the tax liability. So if we are living in the lowest historical tax rate in the history of our country, why would you want to defer the taxes today and wait to pay it at some point in time in the future? By the way, all the money that you may have in the future in your tax defer account, like your 401ks, 403bs, and your IRAs and so forth, you really don't know how much of that money is yours, because the IRS is going to be determining at some point in time what percentage of all that money belongs to them. And always remember that what belongs to the IRS will always, always belong to the IRS from a business perspective. Now, step number 8 is when we start getting into the execution. So here's what we've done so far. We've done the future value calculations on the assets that a client may have or you may have in your taxable bucket. We've done the same thing for the tax deferred bucket. We've done the same thing for the tax free bucket, which is one that we don't have to worry much about. And then obviously we've done the net present value calculation to make certain that the combination of the assets that we have in the tax deferred bucket upon distribution do not create an additional tax liability, if any at all. Now, always remember that the tax deferred bucket, when you put the money in, the money goes in pre-tax, the money grows tax deferred. But then when you pull the money out, you're supposed to pay taxes on the entire thing. Now, what if by doing a customized retirement blueprint with our firm, we can help you and give you the ability to put the money in pre-tax, have the money grow tax deferred, and then pull it out tax-free. Now, that would be a win, win, win for you and your family for many, many years to come. Now, the last part, taking the money out tax-free, you cannot do in a tax-deferred or taxable account unless you have put together a customized retirement blueprint. Now, the execution part in step number 8 would be, using the net present value calculations will determine, again, as I already stated, how much money should be in the taxable bucket and how much money should be in the tax deferred bucket. In other words, what the ultimate goal is going to be 10, 15 years from now, whenever you decide to retire. So in the example of the 50-year-old, he or she wants to retire, or they want to both retire at age 65. So we have a 15-year calculation that we must be able to do. And then by doing so, what we want to do is we want to start shifting to step 5, which is the tax-free bucket on an annual basis. Not only the contributions that we would be making traditionally to your tax-deferred bucket and also your taxable bucket, because at the end of the day, we want to shelter the majority of retirement assets in step 5, which is the tax-free bucket. So other than the minimum that we're supposed to be having in the taxable bucket, which would be, 6 months of expenses, perhaps a little bit buffer, a little bit more, for business opportunities and so forth. And then no more than $500,000 to $550,000 in your tax deferred bucket by the time that you retire. Everything else, every spill, every overage over that amount should go directly into your tax-free bucket. Now, once we get to step number 9, here's where we start to identify, what are going to be the critical products and services that are going to be suitable for our clients and for you, the listener, once you've done step 1 through step 8. Now, you want to be able to create an economic straddle, which is a financial products combination that allows for maximum efficiency between the taxable, the tax deferred, and the tax-free buckets. Now, the mathematical calculated amounts of assets in your Roth IRAs, Roth 401ks, and 7702 plans will and may allow for you and your family to receive the following. Number 1, when you retire, there would not be taxes on your Social Security benefits. And yes, unless you do proper planning, up to 85% of your Social Security benefits may be taxable in retirement. Didn't that feel like a taxation when you were making those contributions while you were employed? So yes, there may be a tax on the back end on the way out as well. So no taxes on Social Security benefits if you do it that way, the right way. No taxes on qualified distribution plans. Like IRAs, 401ks, 403bs, etc., due to provisional income planning and calculation offset that we do with each and every one of our clients as part of the customized retirement blueprint. No taxes on Roth IRA distributions. No taxes on Roth 401k distributions. And last but not least, no taxes on the 7702 plans that we had talked about. I think it was a podcast that we did 3 weeks ago, and I'll go into more detail on the 7702 planning calculations in next week's episode of the podcast. Now, think of it this way. If you have no taxes whatsoever to pay, due to the 0% effective tax rate during retirement distribution years, this planning strategy may actually qualify retirees, now not that any of you may want to do this, to receive some additional certain governmental benefits that you would not otherwise receive, like Medicaid, food stamps, and other government programs. So think of it this way. If all your assets in retirement are coming out of your Roth IRAs, Roth 401ks, and your 7702 plans, and you've done proper planning with a tax-deferred bucket, and you're generating, I don't care, you may be generating, $100,000 of income annually, $150,000, $200,000 of income, but because none of it is reportable for federal income tax purposes, you're pretty much able to qualify for other governmental benefits that otherwise you would have never been able to qualify for. Now, whether you decide to exercise some of those benefits, that would be entirely up to you. Now, the last step, which is step 10, and these are the planning objectives. Obviously, the retirement tax planning distribution system that I have just walked you through also provides an array of additional benefits for retirees today and in the future. Now, these benefits are, for example, they provide protection against the risk of dying too soon. So obviously, we do a lot of tax-preferred retirement planning to make certain that if our clients have a premature death, that it does not have a negative impact from a financial standpoint on the surviving beneficiaries or surviving spouse. It also provides protection against the risk of living too long, and the foundation and provides a foundation for guaranteed income. Most of the investments that we provide for our clients, we want to emulate additional Social Security benefits or pension benefits. As you can imagine, most of the major companies in the U.S. are doing away with their pension benefits to their employees because they're extremely costly. Well, if you do proper planning and you have to pay no federal income taxes to the IRS and you don't have to take as much money out of your tax deferred or taxable bucket or tax-free bucket in order to make ends meet. And if in addition to that, you want to protect against the risk of living too long and you want to take a portion of your assets and buy principal protection and guaranteed income for life, then you have the ability to create a number of other guaranteed pensions that will not die before you do. Now, this type of planning also provides protection against the risk of living disability, especially when we are planning under 7702 and some of the other investment plannings that we do under tax-deferred bucket. We do have the ability to provide additional benefits to our clients that in case they have a need for long-term care and retirement because of a large number of retirees are going to suffer some kind of a long-term care and they may need care in the future, that obviously they're fully protected against that potential risk. And last but not least is you want to protect against the risk of living with eroding factors. And that's where, by doing the type of planning that we provide under our customized tax-preferred retirement blueprint, we're able to mitigate and or eliminate taxes. We're able to stay ahead of inflation, we're able to provide guaranteed income, and we're able to protect that income in case of potential litigation and or lawsuits. Now, one of the major things that we do at Cambridge is that this tax-preferred retirement blueprint that I have just walked you through, it forms part of what we call the Cambridge Capital Management System. So in addition to all the stuff that we have just covered, including risk management assessments, the Cambridge Capital Management System provides the following benefits to our preferred platinum members. If you're a client of Cambridge, you are a platinum member from that perspective. So we also provide, as part of the blueprint, Social Security benefits report. We want to make certain that you understand when is going to be the ideal time for you and your spouse and or surviving spouse to start taking Social Security benefits. We also do a tax forwarding report every single year because we do tax planning. Not only do we provide accounting services to our clients, but we also provide tax planning services. And the tax forwarding report allows us to look forward into the future so we can maintain that 0% tax bracket throughout your retirement years. We also do comprehensive economic models depending on your income needs, asset needs, propensity to consume, death and disability calculations to make certain that there's an efficient transfer of assets at time of death or retirement. And we also put together a comprehensive retirement distribution report that deals with certain investments, including life settlements and principal protection vehicles that are so critical in retirement. And then for those of you that become clients of Cambridge and become part of our Platinum Members platform, you're also going to have a monthly educational webinar that we provide, and that is an exclusive monthly educational webinar for our Platinum clients, and we host those the third Saturday of every single month, except for the months of July, August, and December. And if you don't have the time to attend or you may be out of town, we record each and every one of those educational webinars, and then we send them to you so you can watch them and review them at your convenience. And then obviously if you happen to be one of our clients, we do client reviews, and we do those 3 times a year because we feel very strongly that although there's more information in the marketplace than ever before, Americans are worse off than they've ever been. So information without education always, always, always leads to failure. And I want to leave you with the thought that I leave you with every single week, in that my job and my goal and that of my firm is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thank you so very much for joining us today, and look forward to talking to you again next week, where we're going to be talking about our 7702 distribution plans in more details. Take care. Have a great day.